The Federal Reserve kept rates unchanged on July 30th, but the bond market delivered its own rate increase. This is exactly the danger we warned about in our earlier video. The safest investment turns risky. If you have not watched that video yet, click the link below. It explains why long-term yields will keep rising and its impact on bonds, stocks, and other assets. The Fed held its benchmark rate at 3.5% to 3.75% for a fifth consecutive meeting. But three officials dissented in favor of a quarter-point increase, a clear sign that inflation anxiety is rising inside the Fed itself. Markets heard something deeper. If inflation stays persistent, policy may need to stay tighter for longer. Two-year yields declined as traders reduced expectations of an immediate hike, but the 30-year yield climbed to around 5.21%. That placed long-term US Treasury yields near a 19-year high. A major warning for long-term investors. Investors are demanding greater compensation for long-term inflation risk, fiscal risk, and policy uncertainty. This is not just a yield rate move, it is the market charging a higher price for long-term uncertainty. Our earlier thesis was simple. When inflation, national debt, and uncertainty rise together, US long-term yields will be higher for longer. Some fund managers are now shorting 5- and 10-year US Treasuries, reducing long-term US exposure, and favoring bonds in Australia, Europe, and Asia. When yields rise, bond prices fall, and the longer the maturity, the deeper the move. Higher US Treasury yields do not stay inside the bond market. They raise mortgage costs. They also raise corporate borrowing costs, pressuring leveraged businesses and weakening profit margins. And stocks are not immune. Higher long-term yields can compress valuations, especially for expensive technology shares. Higher for longer, US Treasury yields are no longer just a forecast. The bond market is already enforcing them. For long-term investors, this must become a basic assumption. Duration risk is real, financing costs matter, and valuations require more discipline. When yields keep rising, risks across US Treasuries, bonds, stocks, and other assets will continue to rise. Investors must be cautious.